We have with us this morning Troy Eblen, CPA from Kemper CPA Group. He's going to be briefing us on changes in state and federal tax laws that we might all be interested in. I know that you're thinking, terrific, I showed up today, we're going to talk about taxes at the keynote, but I'm sure Troy is going to make this interesting because it does impact us all, and I'm trusting you to do that, Troy. Troy graduated from the University of Southern Indiana with a bachelor's degree in accounting and finance and went on to earn his CPA. Joined Kemper Group in the Evansville, Indiana office in 2013 and transferred to the firm's Henderson County office in 2017. He has experience in the areas of accounting and auditing as well as income taxation for individuals and businesses, including multi-state corporations. In addition to tax matters, Troy has experience in the oil and gas industry, working with independent producers and affiliated service companies. Please join me in welcoming Troy Eblen.
No pressure to make this interesting. Our shameless plug. I know Kemper does the audit here for GRADD out of the Evansville office, so you guys have probably seen Michelle and Smith and Eblen give those presentations in the past. We have offices in Kentucky, Indiana, Illinois, and California. Some of the services that we provide are taxation, auditing, payroll, and we have an IT division that can help with website design, anything like that if you ever need some help with anything. Now to some of the fun stuff. I put this in there for a little chuckle because you guys probably heard back in 2018 whenever they're trying to pass the new tax bill, they're going to make it smaller, the tax code, and they're going to put it on a postcard. Well, the front page, I guess maybe was the size of a postcard, but they moved everything to subsequent schedules, so in total it didn't really change. If anything, it got a little more complicated, and we'll get into that in a minute, but it definitely didn't get any easier, put it that way. Overall, you guys by and large you should pay less tax, I guess, because the rates went down across the board. The top rate used to be at 37% or 39%. It went down to 37%. So, and the buckets all went down as well. So if you compare your 2017 return to your 2018 and now even your 2019, dollar for dollar, you're going to pay less tax. So that's a good thing for everybody. Some of the major changes that took place were dealing on the individual side were the standard deduction. So you used to get dependent exemption credits. Well, that went away, and now you just get a large standard deduction, which is, it was $24,000 in 18, now it's $24,400. So it went up, but basically that's going to wash for like a family of four. But if you're just a married couple, you're going to get a larger deduction, which helps most people. Another thing that changed was, and this is a 2019 improvement to the tax code, was you can take $5,000 out of your 401k penalty free for either adoption cost or child care, and you're still going to have to pay tax on the withdrawal, but you get out of the 10% penalty. So I know I just had a kid and we're too late. Health insurance, before, if you didn't have health insurance, you were hit with a penalty. That was repealed, so in 2019 and going forward, there's no more penalties for not having health insurance. The employers are still required to do the 1094C and 1095C filing requirements, but at least the penalty on the individual has gone away. So you guys may have heard of the RMDs, required minimum distributions. So if you have retirement plans, as you get older, you're required to start taking out payments out of your 401k. Well, that used to be at 70.5, but now they've allowed you to later at 72, you can now start pulling out. So you've got an extra window to let it to let it sit there without having to pull money out of your 401k. And then also, before you weren't allowed to put money into your 401k. Once you reach this age, now you're allowed to keep putting it in, and even if you are pulling money out in the RMDs. So that's a change for the older folks. 529 plans is a great way for tax savings for colleges, for kids or grandkids. And they've opened that up. It used to have to be you had to pay for books or the actual tuition. Now they've allowed you to pay back interest on your student loans or the principal, either one. So that's an added benefit. They've kind of loosened some of the constraints on what you can use your 529 plan money for. The mileage rate, I don't know if you guys have Schedule Cs or Schedule Es and you're using your personal auto to do any kind of business, you can get you track your mileage obviously, but you're going to get a 58-cent per mile deduction in 2019, and then it went down in 2020 to 57.5. So that's just kind of to cover wear and tear and your gas and things like that. But it's easier. So you're allowed to do two options. You can either capitalize your car and then you're going to get a depreciation every year, or you can take the mileage. And most people do the mileage just because it's easier. So some of the retirement changes that took place were they index this every year to where they up the amounts. And you guys, I don't bore you with going through all those, but across the board, you're allowed to put more money into your retirement plans for 2019, and then they index it every year. So in 2020, it's even going to go up even more. So those are nice ways to think about the future, and especially if you do like a Roth IRA and you can save money because it can grow tax-free. The key is always pay less tax, right? That's what everyone wants to do. The thing that caused us probably the most headache in trying to wrap our head around this new tax code was QBI. We could spend probably 3 hours talking about QBI and not cover it all, but so any business owner, whether that's just a sole proprietor, an S corporation, partnerships, LLCs, anything like that, you're going to be eligible for a QBI deduction. Now, the easy answer is it's 20%. It's a 20% deduction of whatever your net income is. But they're, like Congress does with most things, they add a lot of buts to it. And that's what this flow chart kind of tries to describe. So depending on what type of business you have to, it can be limited to 50% of your wages, 2.5% of your qualified property, which is your fixed assets you capitalize on your business. But if you just have mainly a straight Schedule C, you're going to get a 20% of net income deduction, which is something we haven't never had before. So that's a nice deduction that we got out of this, and most of our clients benefited greatly from this. So if you haven't had your 2019 return prepared yet, you may make sure you're going to get that QBI deduction because that'll help save you some tax. It doesn't offset self-employment tax, but it does offset income tax, which is nice. Some of the depreciation changes. Bonus has been around for a while now. Bonus and Section 179 are almost the same thing from a taxpayer perspective. So if you buy a car, you can 179 it or bonus it out, which basically means you can write it all off in the first year. Whereas normally you're going to get it over 5 years, which is not as good of an answer especially if you're a business that's buying a lot of fixed assets, because you like to match your deductions with your cash outflow. So if you're if you're a manufacturer and you go out and buy a piece of equipment, well, you're going to pay cash for it, but if you can't get the deduction but over 7 years, that's not a good answer for you because you've already paid the cash. So we like to try to match those together. Those are going to be sticking around for a few years. They index the Section 179 every year, but basically if you don't spend more than $2.5 million, you can Section 179 up to $1 million of assets. So most people in our area, that covers most of them. Very few times do we see people that go over that. Earlier I was talking about the postcard. Well, they've changed it again. It's bigger. It looks more like it did in 2017, but still not exactly the same. I threw this in there just because some people may have not seen the new return yet. Before it cut off right there after the dependents. That was your 28 return. So 19 they've added some more lines. I don't know why they've changed it, but maybe just for changing. There's the second page again, and it's, like I said, it's similar to the 2017 return. I wanted to focus a little bit on Kentucky. I know we're close to Indiana, so some folks may be an Indiana resident or file an Indiana return, but Kentucky as well overhauled their tax code at the same time that the federal level did, and they wiped out a lot of deductions that some folks were using, especially the medical expenses. We have a lot of older clients that were itemizing big dollar amounts because of medical expenses, and Kentucky did away with that, which hurt our clientele for sure. Now the only itemized deductions that are allowed for 2019 are your home mortgage interest, your charitable contributions, and they just added the gambling losses. So 2018 you weren't allowed to get the gambling losses, but now you can, to offset up to any gambling winnings that you had. So that's not good. That's not a positive for Kentuckians, I don't think. They've increased the standard deduction. They index that every year. It goes up. It's not a big dollar amount. But the pension exclusion for our retirees, that impacted a lot of folks too. It used to be up to around 41,000 in years past, and they've lowered that down to 31. And what that means is, so say you're on Social Security benefits, and your taxable Social Security benefits are 20,000. Well, as long as you stay under that $31,000 exclusion amount, Kentucky's not going to tax it. But if you say you have Social Security benefits and then you're pulling your IRA or 401k out and you go over that amount, you're going to have to pay the tax on anything above $31,000. So they've lowered that inclusion amount. So that's, again, not something we're happy about. The inventory tax credit that they've put in, so they're going to raise that. In 2018 it was 25%, in 2019 it's 50%, and next year it's supposed to be 75%. And what that means is, if you're filing your PPT return, your personal property tax return with your local county, so you're going to pay property taxes on your inventory and any kind of equipment that you have, in addition to your real estate taxes, they're going to give you a credit back of 50% of whatever the tax was that you paid on your inventory. So we have a few large manufacturers in the area that do have large amounts of inventory, so that credit is nice, and that's new. So that's one of the positives that came out of this new change. Kentucky had always been on a graduated tax rate, with the highest tax rate being 6%. They've went to a flat 5%, which people are paying more tax, because every dollar is going to be taxed at 5% instead of the graduated rate like the federal system is. So that's not a good change either, but it is what it is. Some of the year-end strategies, we like to try to bring folks in so that we can look at their tax situation in December or even earlier, because there can be things that we can do for planning. And some of the things we can run over real quick. So earlier we talked about required minimum distributions that you're having to pull out of your retirement plan. So if you can get in touch with your advisor, whoever has your retirement plan, you can actually take money out of your 401k, for example. And as long as you don't collect it and you send it straight to a qualified charitable organization, that's not taxable to you. So that's a way to get around taking the RMDs and because they increased the standard deduction up to the $24,000 amount, people aren't itemizing like they used to. So if you're giving all this money to charity, you may not get the benefit of it because you're going to get a free $24,000 standard deduction. So if you do it this way, you're not going to pay tax on whatever amount that you send to a charity. So that's a way to get around the $24,000. So you're almost getting a double benefit, and that's something we've tried to encourage folks to do. If you're only given, a few $1,000s every year to charity, one thing we've advised some folks to do is try to bunch those. So maybe this year you don't give, and next year you double that amount, to where you might get over the $24,000 hump, and that can benefit you on your return. Obviously, the HSAs for the health savings accounts to help pay for any medical expenses, going to the doctor, anything like that, we all strongly recommend doing. And this reviewing your investments. I'm no investment expert. That stuff confuses me to death. But in years where you're going to have large gains when you sell some of your securities, you can look at your investment portfolio before the year end, and if you have some losers that aren't performing as well, if you sell those before year end, those losses can offset that gain. And the IRS allow you to deduct $3,000 a year in losses on selling securities. Excuse me. And then for business owners, that's your Schedule C's, partnerships, and S-corps. If you're a cash basis tax payer, which all of us are for the most part, just delaying receipts. So if you know you're going to get a big check in at the end of the year, don't go to the mailbox. We don't want to see it. Don't put it in the bank, because it's all about delaying it. So if you speed up your expenses and not collect the revenue, you can play with your income from year to year, which that's where planning comes into play. So if we can get you down into a lower tax bracket, that might be worth your while to do something like that. And if you're a accrual taxpayer, that doesn't work. But most folks that are small taxpayers, like your regular partnership, your farm partnerships, and some of your small local businesses, they're all cash basis. So we utilize that technique as well. I know I ran through that pretty quick, and I don't know if anyone has any questions for me or anything, but I'd be happy to answer.
Are there any online resources governments can use to help communicate some of this to our employees?
Well, the IRS sends out a bulletin.
Something other than the IRS. Something simpler than what they're... We have a bulletin Kemper sends out, and we can get you guys on the mailing list. But as far as, no, not really. We go to CPE events every year to keep our license up to date, and they give us big books that are terrible to read. But all kidding aside, does the IRS have some fairly easy to understand resources?
No. The IRS doesn't make anything easy. Yeah. But that's why I put in that slide. It's the hardest income tax, one of the hardest things to understand. And anytime you think you might get a handle on it.
Right, yeah. We used to, as a staff member, sometimes as a customer too, we used to get the regular email from our, CPA in the past, as well, any changes coming up, some deadlines coming up. If the Kemper is doing that, can we give you the email addresses of all the board members that you can also,
Yes.
on a regular circular that comes every quarter saying, hey, there is a time to do this, or laws are changing this. So that's why I think Judge Snyder wanted to kind of find out, in the simplest way, how we can keep track of what's going on.
Yes, we can
Do
certainly do that.
Okay. We'll send you the email address of all the board members, anybody's interested.
Okay. Yeah, we can certainly do that. Some of it you guys find interesting, some of you probably don't. We're just hitting this one, but for sure.
The new W-4 is really complicated.
Well, it's supposed to make things simpler.
It hasn't made
Yeah,
it.
surprise, right? So they've done away with this single and married filing joint claiming to. They did away with all of that. I don't know if you guys have seen the new W-4. I don't have a PDF version of it, or I didn't bring one with me, but basically you put in if you have another job, you put in that income, or if you expect to have interest or dividends, you put that amount in, and then in addition to that, whatever amount you want extra to be withheld from your paycheck. How
Yeah, it looks
most
like it.
regular people would ever know what to put there, but it's supposed to be easier.
It looks like you're doing your taxes when you're trying to fill out the W-4.
Right.
Yeah,
It's,
it's very complicated.
I think they have gotten some pushback on it, but we've not received any word that anything's gonna get changed. But most people, what it's designed to do is to keep people from either getting large refunds or having to pay in. It's supposed to match what you're earning to what they're withholding more closely than what was doing in the past. Because I know we've had folks come in and say, I want everything, I want the most withdrawn out of my check that I can, so that at the end of the year when I file my return, I can get a huge refund, almost like a savings account. And the IRS is trying to get away from that. So if that's what you like, that's probably not a good change. Which, to me, why let them hold your money all year interest-free? Because they're not going to pay you any interest on what they hold. So I think it's actually probably a good thing once we work out all the kinks of how to get it entered. And, but anything else?
Well, we want to thank you very much. Here, with that, take it, and this.